Okay, Porter, let's give something useful for our subscribers. We do have a lot of ideas at Porter and Co. Not as many as we had at Stansbury Research. Thank goodness, we're more honed in over here. But one thing that you were really dead set on was starting a permanent portfolio, because we get so many of our subscribers that kind of want the set it and forget it model. And I know that these are things that kind of become boring, because what you'll do is, in the past, select from the current existing open recommendations, stuff like that. It's kind of more not a afterthought. It's kind of more, well, let's just kind of take the hodgepodge of what we have and throw it together. But on this one, you spent a lot of time studying one of your virtual mentors, someone that you respect a lot, which is Harry Browne, and his permanent portfolio.
Yeah.
Why was Harry Browne so impactful on you? Because it was a long time ago. And why have you thought about this for so long before you started this?
I had 4 or 5 really important intellectual and philosophical mentors. Doug Casey, Bill Bonner, Mark Ford, Steve Sugarud. But the guy who impacted me the most from a philosophical standpoint was Harry Browne. And Harry Browne was a libertarian philosopher and economist. And he really taught a very simple ethic, which was that you had to find freedom in an unfree world. And that was the name of, for what I thought was his best book. So How I Found Freedom in an Unfree World. And he really spent a whole lot of time devising solutions to the traps that people find themselves in life. And basically it all boils down to consent. You don't have to actually consent to using their flawed currency. You don't. You have the freedom to choose otherwise. And the permanent portfolio was Harry Browne's solution to our corrupt monetary regime. And the basics of it are really simple to understand. Harry knew that in an inflationary monetary system, there would be long periods of continual inflation, punctuated by very brief periods of deflationary collapse. And because the timing of those collapses were dictated and driven by politicians and by political things, it's virtually impossible for someone outside the center of power to know the timing of those things. Today, we call them rug pulls, right? You
Right.
see it
That's
all the
right.
time. Oh, here we go. Here comes the rug pull. And everyone's
Yep.
going to lose all their money.
The
So
retail bag holder rug pull.
retail bag holder rug pull. So Harry was like, okay, fine. It's fine to bitch and moan about that. But what's the actual solution?
Mm-hmm.
And the solution is that you put your wealth into 4 different buckets. So look, you have to invest for growth because we're in an inflationary economy. If you try to retire and your retirement lasts for 25 years and you don't grow your assets, you're going to run out of money. Your purchasing power is going to get inflated away. And in my opinion, okay, I would say that purchasing power has declined by at least 50% in the last 10 years. So you've got to find a way to grow your wealth. But if you just put all your money in the stock market, you're going to get rug pulled.
Mm-hmm.
If you're a retired person, you can't tolerate a 50% drawdown like we saw in 2008 and like we saw in 2000. You can't tolerate that kind of volatility. You can't. There was a month in 2020 and February where the market declined 30% in 3 weeks.
You can't do that.
You
Can't
can't
tolerate it.
survive that kind of volatility if you're retired. Okay, so you can't survive not growing your wealth, and you because it's so volatile, because it's not a sound system, you also can't survive the deflationary collapse risk. So what do? So you put 25% into stocks, okay? But then you hedge that by putting 25% into bonds.
Mm.
Why? Well, because bonds are going to be pretty stable. And if there's a deflationary collapse, they're going to go up in price, which will shield you from the volatility of stocks falling. All right. But listen, why would you buy bonds? You know there's going to be inflation. Yep, there's going to be inflation. So you hedge your bonds by having 25% in gold.
Mm-hmm.
So you're long stocks, but you're hedged in bonds, and you hedge your bonds with gold. So 25, 25, 25. Well, what's the last 25% for? Well, that is you just hold cash. Why do you hold cash? You hold cash so that when that moment arrives, when the 2000 happens, when the 2008 happens, when the 2020 happens, when there is a collapse of 25% or more in stocks, you have cash that you can shove into the market to continue your growth strategy. So that was the Harry Browne permanent portfolio. And I took a look at that. And I've been studying this, by the way, since the mid 1990s. So I've thought about this a little bit.
Mm-hmm.
I think the thing that Harry got wrong, and unfortunately Harry's not with us to defend himself. He passed away, I believe, in when did Harry die? I think it was 2004. It was a long time ago. But Harry's not here to defend himself. But I think the thing that Harry didn't understand was that he wasn't really a securities analyst. And I don't think he ever thought about how much optimization there could be inside these buckets. So let's take stocks. You want to grow your wealth, but you don't like volatility. So why don't we scan the market and look for high return on equity businesses, high quality businesses that have very low betas. And what's beta mean? No, it's not a husband who lets his wife henpeck him all day. A beta in finance is a measure of volatility compared to the S&P 500's volatility. So if you've got a beta of 0.5, that means that that asset is half as volatile as stocks in general.
Okay.
So the other thing we discovered when we looked at this was if you're going to be a retired investor, should you own something like Facebook or should you own something like Deere and Company? And I say that because if you're a retired investor, you've got to make sure that what you own never disappears. It can't. You can't afford that risk. And so we went looking for these companies that have this Lindy law effect. We went looking for companies that have operating histories in excess of 50 years that dominate these businesses so completely that you can't even, it's impossible for you to think of a tractor without thinking of John Deere. It's impossible for you to think of a beverage without thinking of Coca-Cola. It's impossible for you to think of a cigarette without thinking of Philip Morris. So we wanted high quality, so high return on equity companies that have Lindy lifespans, they're here forever, and completely dominate their markets. So we went and picked a bunch of those stocks to be our stock bucket. And that's something that Harry Browne didn't think to do or didn't think was necessary. He just owned the S&P. I think that we can do better than the S&P by investing in high quality businesses, ROE high companies. And I want the additional security of being in a Lindy company, a company that's been around for more than 50 years. Okay, so high quality and Lindy. In the bond bucket, this is where I had my biggest discrepancy with Harry. I didn't want to own 20-year long-dated U.S. Treasury bonds because I'm certain that our government is bankrupt. I'm certain they're going to have to default or they're going to have to pay off those bonds by printing more money. I don't want to own that asset, but I need some exposure to bonds. So why don't we go find who is the world's best bond fund manager? Who can actively manage bonds better than anybody in the world? And
We might actually have them.
you're thinking, well, I've got Marty Fritzen. Yeah, but
Yeah.
that's distressed corporate
That's
bonds.
distress. That's
That's
not
not the
something
same
you
thing.
want
Not the
to hang
same.
your hat on.
That's not the same thing as a government bond. That's not a sovereign
Right.
bond. Okay. Yeah. Well, you think, well, then you got PIMCO. You've got guys like what was his name? Not Bill Gates. Who's the
Bill Gross.
Bill Gross.
Yep.
And then and the new guy at Double Line Capital. His name escapes me right now too. But anyways, no, I don't mean that. Because why? Because you have to pay those guys.
Right.
I don't want to pay any. I just want someone to manage my bond risk for me for free.
Mm-hmm.
In fact, it'd be better if they paid me a dividend. And if you go,
yes.
if you go and you study property and casualty insurance firms, what you discover is that their market caps equal the size of their bond portfolios. So if you go look at W.R. Berkley, it's a $20 billion company. It's got $20 billion worth of bonds. And it just so happens that Bill Berkley is probably the best sovereign bond manager in the history of the bond markets. And he's working for me for free. In fact, he's paying me to hold these bonds. So what I did was I said, listen, let's not buy bonds directly. Let's buy insurance companies that own lots of bonds so we get underwriting profits and so we get great bond managers. So that's a big difference in our permanent portfolio. So we've got on the stock side, we've got high return on equity companies that have Lindy historic characteristics. On the bond side, we got property and casualty insurance companies, and we're great analysts for those. We have the very best P&C firms for you laid out. And then when it comes to gold, well, no offense to Harry, but in a lot of ways, Bitcoin is better than gold. You can send it on the internet. It has the advantages of the blockchain security. It's a superior form of payment.
Institutional
And
money is piling in. Sovereign countries are piling in. It's not going away.
it's definitely not going away. So what I said was, let's not just own gold. Let's also own some Bitcoin.
Mm-hmm.
And listen, when it comes to gold, I've been around a long time. These streamers are the best way to buy gold. Why? Well,
Royalty
because the
companies.
streamer comes in and says, I'm going to go buy all the gold in the ground now. And then you get to
Mhm.
pay me this gold over the next 20, 25 years. So it turns out that if you were with a high quality gold streamer, then you can actually make more money off of gold than just owning gold. So I said, look, let's own some GLD, let's own some gold, but let's also own the best streamers and let's own Bitcoin. So our gold bucket is a little bit more high performance than Harry's. And then our cash, this is the last part of it, and we haven't yet been able to take advantage of an opportunity with our cash. But our cash portion, the 25%, is not going to be fixed. What we're going to do is we're going to wait for an opportunity in distressed corporate credit. We've got Marty Fritzen guiding us, so we'll know when it's time. And when
Mhm.
it's time, we're going to push that cash into high yield distressed corporate credit. Ideally, when we're going to be able to get about 15% annual yield on it.
And you've seen this happen. You've seen this happen.
Yes, this has happened in my career. I would say it's happened at least a half a dozen times.
And these were the times that you literally have told people, if you really understood how to invest in corporate debt, you never invest in a stock ever again. Period.
Sure, if I can lock in 15% yields for 7 years, I would much
Yeah.
rather have that than a stock. Absolutely, no question. So, I don't know exactly when we're gonna get the perfect setup where the permanent portfolio will perform perfectly, but there will come a year where we do, double-digit return in our stocks, so let's say 12%, all right? We do double-digit return in our property and casualty stocks because of a good bond market, so let's say another 12%. And we do 12% in stocks, or sorry, in gold and Bitcoin, and we do 12% or more in our cash. And in that situation, you're going to have a permanent portfolio where you're earning 12 to 15% a year with virtually no volatility. Now that sounds great, but it also kind of sounds pie in the sky, doesn't it? Oh, how are all the stars going to align where all the buckets do good? Well, I'll tell you this: we started last fall.
Right. Last
I don't
September.
think I don't think last fall was anybody's idea of the perfect time to launch an investment fund.
Certainly not.
But we now have earned 20% returns. That's 30% annualized. And we have a volatility that is half of the markets, which leads us to a Sharpe ratio of 2. So this is trouncing the market. It's more than double the market's return in the period.
Yeah, so Porter, I had
And half the
Jared. I
volatility.
had Jared pull the S&P since inception. So since September 25th, S&P has done 5.5%, and your portfolio has done 20.
That's right. So 3x the S&P with half the volatility.
Yeah, that sounds great.
Yeah, but I'm just guessing, Aaron.
Right.
I'm just
Right.
throwing darts. What would I know?
That's what, like I said before we kicked off this conversation, and one thing that you taught me a long time ago is, especially for big ideas, it's like a shark. They need to bump up against things for a long time before they go for the kill. Like you said, you've been studying and thinking about this since the 90s. This has been something that you've wanted to do, and it was really cool to be at Porter and Company to see you develop this with your analysts, because it finally just all clicked for you. And now you've put it to practice. Volatility is something that young investors love. Volatility is not something that retirees love at all.
No.
And
No.
so
I'll tell
this
you,
is big.
I've done the same exact allocation in my private account.
That's right. You
I've done the same-
showed me the other day, which was
I've done
shocking to
the
me.
same allocations, and my year-to-date return is 47%.
Yeah, I think
And
that's
I know
crazy.
it sounds like I'm exaggerating, but this thing hardly ever goes down because I've got the 3 buckets. By the way, I
Mhm.
don't. Why has my return been higher than our published return? Because I don't hold any cash, and in fact, I've got this thing levered about 40%, so I can tolerate a lot more volatility.
That's right.
But it doesn't. I don't really have down days because if the stock market's bad that day, gold will be way up.
Mm-hmm.
Or if there's a day where gold and Bitcoin are down, then you'll see the property and casualty insurance has done well because bonds are up.
That's
So
right.
it's just these are uncorrelated asset classes, and by owning all of them and by generating alpha, meaning better than average results in each category, it is possible to beat the stock market by a wide margin with less risk. And everyone says that's impossible, but we've been doing it.
That's right. And that's what I wanted to bring up today because I think this is a massive breakthrough. This is the reason for me, single-handedly, not everybody wants to be an active investor. Not everybody wants to trade all the time and read all the time and do all that. Some people do. A lot of our subscribers love it, but a lot of our subscribers really want to set it and forget it. But this isn't going and buying Vanguard. This isn't going and buying PIMCO. This isn't buying some garbage thing.
No, you don't have to pay any fees.
Exactly. Incredibly calculated. And like you said, you get paid. With property and casualties, you're getting paid for these, and for the big companies that we're investing in, the capital efficient companies with dividends, we're getting paid for these. So I wanted Porter to. I didn't really get your approval for this, but I want to give a 40% off for anybody that's not a big secret on Wall Street because I created a domain for this. I know.
Let me explain. Let me explain. Okay. Let me explain.
Okay.
I spent 30 years of my life figuring this stuff out.
Right.
Okay. And I wrote it all down for you in like a 20-page document. Okay. I spent my life building this. All right. And we're now tripling the return of the stock market with half the volatility. And it's actually paint by numbers. I tell you every single individual security and exactly how much of it to buy.
Yep.
And you're going to,
I'm going to give a discount.
You're just going to,
I'm going to cheapen it. But here's the thing. Look, one thing that you taught me, Porter, is sometimes you just got to get these people in. Just like with Marty Fritzen. How hard is it to get these people to buy his service and actually call and get a QSIP? So I'm going to do it, Porter. Get mad at me all you want. It may cost me my job. portersportfolio.com. portersportfolio.com. Please take advantage of this. Even if Porter gets a little bit upset with me, I know that the testimonials will be well worth it.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.